Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, May 9th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro events, of which there are three. As the Bank of England's, the Bank of England guides incrementally dovish. Soft wage data in Japan supports a dovish BOJ, and jobless claims spook headline readers. So the nuance there is that the Bank of England meeting incrementally guided market participants towards rate cuts after a second monetary policy committee member voted for a cut. Elsewhere, Japan's soft March wage data recently supported the recently affirmed dovish policy guidance by the BOJ. And lastly, initial and continuing jobless claims data offered investors their first clue regarding whether last week's stagflationary ISM Services PMI report was a one-off in response to a month or so of tighter financial conditions, or the beginning of the end of our near two-year-old resilient U.S. economy theme. In terms of market implications, though the jobless claims data moved in a negative manner per the largest percentage increase in the four-week moving average of initial claims since January, the net result is jobless claims are still signaling a low probability of a developing recession in the U.S. economy, as are the 42 macro Fab 5 recession signaling indicators. Rather than panic, speculate, or get horned up on bear porn, because the most volatile institutional asset in the world, i.e. Bitcoin, is down 17% off its highs, we will let you know in real time when that signal changes. No change to our broad macro risk management guidance. Transitioning to our 42 macro dashboard. As always, we'll wrap up with the question from our community. This one reads, utilities and inflation versus deflation. Inflation and deflation are two of the four regimes in our grid process. So the question reads, I was surprised to see utilities backtest do well in your inflation backtest and poorly in deflation. Intuitively, I would have expected the opposite. Because of their steady, dependable yield, they're usually framed as a bond-like defensives, so I would have expected deflation to do the best. It would seem to me that a rising rate regime like inflation should be terrible for them. Maybe I'm stuck on first order thinking there. Curious if you have a fundamental or second order explanation of why you'd historically do so well in inflation. And so generally speaking, what happens in inflation is that duration risk really takes over asset markets. So I'll explain the various components of this question because I think it's a really good, thoughtful question to unpack. So just kind of working backwards, any fundamental or second order explanation of why you'd historically do well in inflation. So the reason for that is inflation, the key driver of asset markets, the key risk that markets are focused on in a risk-off inflation market regime is duration risk, i.e. rising interest rate risk. And what happens when duration risk becomes the dominant driver of asset markets, investors flock into securities and assets that have low duration risk, i.e. assets that are higher yielding and have shorter maturity profile. So for example, for utilities, their dividend yields tend to be higher, and also the cash that they're generating tends to make the asset have a shorter maturity power, shorter duration risk, because it's generating more cash in the near term versus assets like speculative tech stocks that all the cash that they're likely to generate as well into the future. So that's partially why you see that factor dispersion in inflation. And then with respect to deflation, the deflation regime, utilities are still one of the best performing sectors in a deflation market regime here. As we show here, it's not one of the best performing. It's kind of a middle of the pack sector there. Healthcare, consumer staples are actually the best performing sector in terms of our grid asset market backtest. But the one thing I will say in terms of how we communicate our factor preferences across the various market regimes, specifically vis-a-vis our discretionary risk management overlay table and the proper trade logic for each of those factors within them, our grid asset market backtest is only one of two components that feed into that proper trade logic. And so the grid asset market backtest, for those who may not be familiar, we've backtested all the major factors in the world across equities, currencies, commodities, across all the major asset classes as well, vis-a-vis annualized expected returns, percent positive ratio of volatility and covariance, to understand how the asset is historically traded across the various grid regimes, so that we can program the various tools and risk management frameworks that we use to correspond to incorporate that information. But that's only one step of that process, because one thing we know when we're building backtests is that we don't have enough data to train any backtest on for an inflation regime. Most of the time series that, like, for example, U.S. equity sectors or U.S. equity factors or the various credit sectors within the fixed income market, they don't have enough time series that extends far back enough in time to train a backtest model on how the asset is likely to trade in a regime where inflation is well above trend like it is today. And so, one of the ways we get around that in terms of fixing the grid asset market backtest specifically is truncating the time period between December 1982 and January 1998. Not truncating, but rather removing it from the backtest so that we're not overly biasing the output of the backtest with the great moderation and the trending structural disinflation that we observe there and the perpetual decline in bond yields that we observe there, because then that will just skew the backtest to only knowing how asset markets traded during that particular regime. Well, we're in a new regime, which we've been arguing since 2020, the beginning of 2022, when we published our secular inflation model for the first time. We are in a new regime. We're in a regime that is structurally higher inflation, structurally larger budget deficits, and in our opinion, a monetary policy kowtowing to fiscal policy, i.e. fiscal dominance, being one of the key drivers of this new fourth turning regime that we're in here in terms of broader economic conditions. And so, in our opinion, trying to understand how asset markets behave in this regime is difficult because, again, we don't have enough data that extends far back enough in time to train the model on how asset markets historically behaved in the last high inflation regime or even in the previous high inflation regime, which spanned for most of the 1940s. We have index data, how the S&P traded, how gold traded, how treasury bonds and treasury bond yields traded, how crude oil traded, how the dollar traded, back in the 70s. But when you kind of drill down beneath the hood into sectors and style factors and various sectors within the fixed income markets, as we said earlier, you just lose the time series. You don't have enough data to train the model on. So we have to use our intellect, in my experience, and our acumen from doing this for 15 years to kind of help also to further program the proper trade logic in our discretionary risk management overlay, which is the primary tool we use to help sort of discretionary investors kind of stay on the right side of factor risk in terms of picking the right sectors and the right factors within the equity market, within the credit markets, across global macro, et cetera. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, May 9th, 2024. Everyone have a wonderful day out there. Best of luck. We will catch you back here tomorrow. Cheers.